11:47 p.m. Eastern Time, December 27th, 2025. A screenshot appears in a private metals trading group. A withdrawal slip from a Shanghai vault facility. 300 kilograms, gone. Claimed and delivered. But then the flood began. Within 2 minutes, 47 more screenshots hit the channel. Different vaults across Shanghai, different quantities, but every single one showing the same thing. Physical silver leaving Chinese warehouses at a velocity nobody had witnessed before. By the time New York traders were grabbing their morning coffee on Friday, December 27th, the entire market structure had fundamentally shifted. Shanghai opened trading at $81.99 per ounce. Comex futures in New York still stuck at $79.54. That $2.45 gap isn't some temporary pricing quirk. That gap is the sound of a market fracturing in real time. It's physical reality screaming that the paper system has lost control. If you've been stacking silver, watching this market, waiting for the moment when everything becomes undeniable, you're living in that moment right now. Today. Saturday, December 27th, 2025. What I'm about to walk you through will fundamentally alter how you view commodity markets. Because what unfolded this week wasn't just another price rally. This was a calculated strategic move by the world's largest industrial economy to lock down physical supply before a shortage transforms into an outright crisis. China just made a decision that will reverberate through global markets for the next decade. The Comex is watching its authority dissolve as Eastern buyers pay premium after premium for metal that's supposedly abundant according to Western inventory reports. I'm going to show you exactly what happened inside those Chinese vaults. I'm going to walk through the delivery data proving Western inventories are hemorrhaging. I'm going to explain why that $2.45 premium is actually the most conservative estimate of the real supply crisis. And I'm going to demonstrate why the next 30 days will determine whether Comex survives as a functional exchange. The game just fundamentally changed. Most investors won't realize it until the metal is already gone. Let me take you back 6 months so you understand how we arrived at this breaking point. In June 2025, the silver market looked completely normal. Comex was trading around $52 per ounce. Shanghai ran maybe 40 cents higher. The system functioned smoothly because China served as the global release valve. They'd take raw silver ore from Mexican, Peruvian, and Bolivian mines, process it through their massive refining operations, and export finished bars to London and New York. Everyone in the industry assumed this was permanent infrastructure. It wasn't. Something shifted in late September. Chinese dealers started reporting unusual purchasing patterns, not from investors, but from manufacturers. Solar panel companies were placing orders 3 months ahead of schedule. Electronics manufacturers were doubling their typical inventory levels. Initially, analysts dismissed it as pre-holiday stocking. But the buying didn't stop. It intensified. By October, Shanghai Futures Exchange inventory, which typically maintains between 1,000 and 1,200 metric tons, dropped below 900 tons, then 800. The decline was relentless. Industry insiders started circulating whispers about a leaked government memo from Beijing's Ministry of Commerce. The rumor claimed that starting January 1st, 2026, all silver exports would require explicit government approval through a new licensing system. Only state-approved companies producing more than 80 metric tons annually would qualify. Most market participants assumed it was noise, until November 12th, when the official announcement came through government channels. It was real. China wasn't just restricting silver exports, they were building a wall. If you don't understand the silver supply chain, you might think this is just one country making a policy adjustment. Let me explain why this is actually a seismic event. China doesn't just produce silver, they control between 60% and 70% of global refining capacity. When a Mexican mining company extracts silver ore, they lack the infrastructure to refine it into investment-grade bars. They ship the concentrate to China. When Peruvian operations extract silver as a byproduct of copper mining, same thing, off to Chinese smelters. Even American mining operations send raw material to China because Western refining capacity was deliberately offshored over 3 decades. China sits at the choke point. They're not just a producer, they're the processor, the gatekeeper. And on January 1st, just 5 days from now, they're closing that gate. Do you grasp what this means for every industrial consumer of silver? Samsung needs silver for circuit boards and smartphones. They can't substitute it. Tesla needs it for battery technology and solar roof systems. First Solar needs it for photovoltaic cells. These aren't optional purchases. These are mission-critical inputs. There's no alternative material. Silver is silver. You either have it or your factory stops. When Beijing announced the export restrictions on November 12th, procurement managers at every major technology company globally made the same calculation. Buy now. Buy everything available. Buy at any price. The scramble began immediately. Shanghai prices started climbing, not gradually, but violently, from $68 in mid-November to $73 by Thanksgiving, then $76, then $79. By Christmas Eve, physical silver in Shanghai closed at $78.49, but that wasn't the peak. In the physical dealer network, bars were changing hands at $81. By yesterday, December 26th, premiums exploded further, $81.99 on the exchange. But walk into a dealer in Shenzhen or Beijing, and you're looking at $84 to $85 per ounce for immediate delivery. The premium over Comex had blown out to over $8 at one point this week. Under normal conditions, Shanghai trades at a 20 to 50 cent premium over New York. A $1 premium is considered tight. When we saw $2 premiums in October, analysts called it a warning sign. $8 is not a warning. $8 is a market dislocation that hasn't occurred since 1980. Here's what should terrify every paper trader. That $8 premium should have disappeared within hours. This is textbook arbitrage. When Shanghai trades higher than New York, smart money buys cheap metal in New York, ships it to Shanghai, and sells for profit. The price gap closes. Except it's not closing, it's widening. Yesterday, the gap was $2.45. This morning, rumors are circulating that physical dealers in Shanghai are quoting $83. If Comex opens Monday at $80, that's a $3 gap. Why? Because the arbitrage mechanism can't function. You cannot ship metal that doesn't exist. Now let me show you what's happening inside Comex vaults. Comex tracks silver inventory in two critical categories: registered and eligible. This distinction is everything. Registered silver means it's available for immediate delivery against futures contracts. Eligible silver means it's sitting in a Comex-approved warehouse, but it's not for sale, it's customer storage. In 2020, Comex registered inventory peaked at over 200 million ounces. Fast forward to today, December 27th, 2025, registered inventory sits under 70 million ounces. That's a 73% collapse in 5 years. But even that number is dangerously misleading. In the first 4 trading days of December, over 47.6 million ounces were claimed for physical delivery. That's 68% of available inventory claimed in 96 hours. Think about the implications. If you're a futures trader and you decide you want physical metal instead of cash settlement, you're supposed to be able to take delivery. That's the entire premise of the futures market. But what happens when 68% of available metal gets claimed in 4 days? The mathematics don't work. There isn't enough metal to cover the open interest if even a fraction of contract holders demand delivery. Comex knows this. So what did they do? They started playing accounting games. JP Morgan shifted 13.4 million ounces from registered to eligible on December 19th. They took deliverable metal and reclassified it as non-deliverable. On paper, total Comex inventory still shows 451 million ounces. Headlines will say, Comex holds 451 million ounces. No shortage here. But 400 million of that is eligible. Customer storage, not for sale. The actual deliverable supply, the registered inventory that matters, is collapsing in real time. If this were a bank, we'd call this a run. Comex is experiencing the silver equivalent of a bank run. Contract holders are saying, I don't want your paper promise, I want my metal. And the vault is responding, we're going to need a minute. Now contrast this with Shanghai. Their visible inventory dropped to 39 million ounces by late December. On the surface, that sounds worse than Comex, right? But here's the critical difference. In Shanghai, inventory is real. When a bar appears in Shanghai Gold Exchange vaults, it's there, it's available, it's not double counted, it's not leased 5 times over. It's a physical bar waiting for an industrial buyer. And those buyers are lined up. Chinese dealers report that 15-kilogram slabs sell out within hours of arrival. Every single ounce entering the Shanghai system gets absorbed immediately by electronics manufacturers, solar companies, or investment buyers. The inventory number is low because demand is infinite and supply is finite. That's a healthy market signal. It's telling you the truth. The price should be higher. Which market are you going to trust? The one that admits it, has 39 million ounces and prices accordingly? Or the one that claims 451 million but can't deliver when you ask? This is why Shanghai trades at $81.99, while New York sits at $79.54. The Chinese price reflects physical reality. The Comex price reflects paper fantasy, a derivatives casino where most contracts settle in cash. The gap between fantasy and reality is $2.45 today. It'll be $5 by February, $10 by March. We've seen this script twice before, 1980 and 2011. Both times, The establishment thought they could control the narrative, but the circumstances were fundamentally different. In 1980, the Hunt brothers tried to corner the market using leverage. Comex changed the rules, implementing liquidation-only trading. The price collapsed. The Hunt brothers went bankrupt. But 2025 is not 1980. China is a sovereign nation with $4 trillion in foreign reserves, paying cash for a strategic industrial commodity. You can bankrupt a speculator by changing margin requirements. You cannot bankrupt a government buying for its own national interests. In 2011, silver rallied to $49.50, driven by paper speculation. There was no physical shortage. When Comex killed the paper speculation with margin hikes, the price collapsed. But 2025 is not 2011 either. This rally isn't driven by retail speculators. It's driven by industrial users competing for depleting physical supply. There's a real shortage. Raising margins doesn't create silver. Here's the mechanism that makes this unstoppable. The industrial bid is infinite. When Samsung buys silver, they're not speculating. They need it. They have production targets, contractual obligations. If silver goes up $5 per ounce, they pay it because the alternative is shutting down the assembly line. A $5 increase in silver costs Samsung maybe 50 cents per phone. The phone sells for $1,200. That's a rounding error. But shutting down the factory costs millions per day. So they pay. Tesla pays. First Solar pays. They have no choice. This creates a rising floor. Every time silver dips, industrial procurement algorithms trigger. These aren't humans making emotional decisions. These are computer systems with pre-programmed buy orders. These orders are set by CFOs, who looked at the supply deficit, looked at China's export ban, and concluded that $100 silver is inevitable. So they're front-running it. This is why $79 held this week, even as speculators took profits. That's industrial demand. And that bid only gets more aggressive as supply worsens. Markets are closed for the weekend. For 48 hours, the Western manipulation machine is offline. But the world doesn't stop. News spreads. The China export ban hits mainstream financial media. Physical dealers start posting sold-out signs. By Sunday night, when Asian markets open, there's going to be a tsunami of buy orders. Funds that were sitting on the sideline are going to panic in. They've watched silver go from $50 to $80 in 6 months. They've seen the Shanghai premium widen. They've read the export ban announcement. Now they're realizing this isn't a bubble, it's a shortage. Retail traders will see weekend headlines and chase. And then there are the shorts. Traders who sold silver short this week thinking the rally was overextended. They're trapped. When the market opens Sunday night and Shanghai posts $83 or $85, those shorts have to cover. Their buying adds fuel. It creates a feedback loop. How high could we go? Conservative estimate, $87 by Monday morning. Aggressive estimate, $92. If Shanghai hits $95 and New York is still at $85, that's a $10 premium. At that point, even mainstream media can't ignore it. Retail FOMO kicks in. We're looking at $110 by mid-January, $130 by February. But let's zoom out. Silver isn't just a shiny metal investors buy. It's the linchpin of the modern energy transition. You cannot build a solar panel without silver. Every single solar panel uses between 20 and 40 grams. Multiply that by billions of panels being installed globally, and you're looking at consumption of over 230 million ounces per year just from solar. That number is growing at 15% annually. Electric vehicles use silver in battery management systems. 5G networks use it in circuit boards. AI data centers use it in high-performance servers. The entire fourth industrial revolution is being built on top of silver, and we're running out. Global mine production is approximately 835 million ounces per year. Total demand this year was 1.08 billion ounces. That's a deficit of 245 million ounces. We've been running deficits for 5 consecutive years. Cumulative shortfall over 1.2 billion ounces. That's more than an entire year of global mine production gone. This is why China is acting now. The renewable energy build-out that every government has committed to requires massive amounts of silver. Whoever controls the silver controls the energy transition. This is resource warfare. And China just made the first major move by locking down exports. The United States sees this too, which is why in November the federal government declared silver a critical mineral, national security priority. But here's the problem. America doesn't have significant domestic refining capacity. We shut down smelters decades ago and outsourced to China. So now we're in a position where a critical mineral for national security is controlled by a strategic competitor. The supply side is fundamentally broken. The demand side is accelerating. Here's the choice. You can believe the Comex paper price and assume silver is fairly valued at $79. You can trust financial media that tells you this is just another commodity rally. You can wait for confirmation from CNBC and Bloomberg before you act. Or you can believe the Shanghai physical price and realize we're already north of $82 with clear trajectory toward triple digits. You can believe the vault data showing registered inventory collapsing. You can believe industrial demand data showing deficits stretching into the future. You can act now while there's still metal available, while premiums are only $2 over spot, while the crowd is still skeptical. Or you can wait. Wait for mainstream media to catch on. Wait for the price to hit triple digits and physical premiums to reach 20%. By then, the opportunity is gone. The metal is gone. The institutions already know. JP Morgan didn't accumulate 750 million ounces because they think prices are going down. China isn't restricting exports because they're worried about oversupply. Central banks in Russia, India, and Poland are adding silver to reserves. They know. If you're getting value from this analysis, hit that subscribe button. Next video drops in 3 days with delivery failure data that Comex doesn't want public. Here's what I'm watching for next week. If Shanghai opens above $85 on Monday, that's the signal Asian buyers are in full panic mode. If Comex gaps up to match, that's confirmation the decoupling is accelerating. If registered inventory drops below 60 million ounces, that's the final warning. If we see position limits or trading halts announced, that's desperation. This is the kind of market environment where generational wealth gets created, not by people who wait for safety, but by people who see the data, understand the implications, and act while everyone else is paralyzed. Silver is not an investment in the traditional sense. It's money. It's been money for 5,000 years. You can't print it. You can't create it from thin air. It comes from the ground at a fixed rate determined by geology. When you hold physical silver, you're opting out of a monetary system based on infinite debt expansion. You're holding a claim on Earth's resources, on physical reality. Comex can print paper contracts, but nobody can print silver. This weekend, tune out the noise. Look at what's actually happening. Vaults are draining. Premiums are exploding. Export bans are coming. Industrial demand is inelastic. Those are facts. And they all point in the same direction. The price is going higher, not because of speculation, but because of scarcity. Stay sharp. Trust the data, not the narrative. The physical market doesn't lie. Metal is metal, and metal is becoming the most valuable substance on the planet. This is just the beginning.